Something extraordinary is happening right now in the precious metals market, and most people have no idea it's even taking place. While everyone's distracted by stock market headlines and crypto volatility, the largest wealth transfer in modern history has quietly begun. And I'm not being dramatic here. The evidence is overwhelming, the data is undeniable, and the implications are staggering. Let me show you exactly what's happening, who's positioning themselves, and why this matters more than anything else in your financial life right now. Central banks around the world just completed one of their most aggressive gold accumulation periods in decades. We're talking about nearly 473 tons added to reserves in just the first half of the recent period. But here's what makes this different from previous buying cycles. They're not slowing down, they're accelerating. And they're doing it while simultaneously reducing their dollar holdings. Think about that for a moment. The very institutions that manage national wealth, that have access to every economic indicator, every classified briefing, every piece of intelligence about the global financial system, they're dumping dollars and buying gold at a pace we haven't seen since the 1970s. Why? What do they know that the average investor doesn't? Let me paint you a picture. Russia just announced a $535 million allocation for precious metals over the next few years. Not just gold, silver, platinum, palladium. They're diversifying into physical assets across the board. China's been quietly accumulating for years, and their official numbers are almost certainly understated. Poland, Hungary, Singapore, India. The list goes on. These aren't random decisions. This is coordinated de-dollarization. But here's where it gets really interesting. While central banks are buying, commercial banks and institutional players are positioning themselves in ways we've never seen before. The COMEX data shows something remarkable. The commercial short position, which has suppressed prices for years, is shrinking. The very mechanism that kept gold and silver artificially low is being unwound. Let me explain what this means in practical terms. For decades, large commercial banks would short gold and silver futures contracts. They'd create massive paper positions that had nothing to do with physical metal. This would push prices down, shake out retail investors, and allow them to accumulate physical at lower prices. It was a game, and they controlled the board. But something changed. The physical market is now overwhelming the paper market. When central banks buy 473 tons in 6 months, that's real metal leaving the system. When Russia allocates $500 million for physical precious metals, that's actual supply being removed. The paper games don't work anymore when there's not enough physical metal to deliver. And this is creating a situation that's unprecedented in modern markets. Think back to 1971. Nixon closed the gold window because foreign central banks were draining Fort Knox. They were exchanging paper dollars for physical gold, and the United States couldn't keep up. So they changed the rules. They made the dollar a pure fiat currency, backed by nothing but faith and military power. That system worked for 50 years. But it's breaking down now, and the central banks know it. Here's a story that illustrates this perfectly. A few years ago, Germany asked for its gold back from the Federal Reserve. Not all of it, just a portion. The Fed said, sure, no problem. But then they said it would take 7 years to return it. 7 years. To return gold that was supposedly sitting in a vault in New York. Why would it take 7 years? Because the gold wasn't there. It had been leased out, rehypothecated, used as collateral for multiple claims. The physical metal had to be sourced from the market, refined, and shipped. This is the reality of the paper gold system. Multiple claims on the same physical ounce. Now imagine what happens when multiple central banks want their gold at the same time. When the paper claims exceed the physical supply by orders of magnitude. When the music stops and everyone rushes for the exits. That's what's beginning to happen right now. The wealth transfer I'm talking about isn't some future event. It's happening in real time. Wealth is moving from those who hold paper promises to those who hold physical assets. From those who trust the system to those who understand its fragility. From the unprepared to the positioned. Let me give you some specific numbers that should wake you up. Global gold reserves held by central banks have been increasing for 14 consecutive years. But the pace has accelerated dramatically. We went from 400 to 500 tons per year to over 1,000 tons in recent years. That's a doubling of the accumulation rate. Silver is even more interesting. Russia's inclusion of silver in their strategic reserves is groundbreaking. Silver has never been a central bank reserve asset in the modern era. But Russia sees what's coming. They understand that silver is both a monetary metal and an industrial metal. They know that the coming energy transition requires massive amounts of silver for solar panels, electric vehicles, and grid infrastructure. And here's the kicker. There's far less silver available than gold. The gold-to-silver ratio in the Earth's crust is about 1 to 19, but the price ratio has been as high as 1 to 100 in recent years. That's a massive disconnect. And it's correcting. When silver moves, it moves violently. In 1979 to 1980, silver went from $6 to $50 in a matter of months. In 2011, it went from $18 to $49 in less than a year. These aren't gradual trends. They're explosive moves that catch most investors completely off guard. And the setup right now is even more extreme than those previous periods. Let me tell you about the supply situation, because this is critical. Gold production has been essentially flat for years. The easy deposits have been mined. The ore grades are declining. It takes longer and costs more to bring new production online. Meanwhile, demand from central banks alone is absorbing most of the annual mine supply. Silver is even tighter. Industrial demand is at all-time highs. The solar industry alone is consuming massive quantities. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure requires silver. And unlike gold, silver gets consumed. It's used in industrial applications and not recovered. Once it's gone, it's gone. So you have declining supply, increasing industrial demand, and now central banks entering the silver market. What do you think happens to price? But here's what most people miss. The real wealth transfer isn't just about price appreciation. It's about the revaluation of what money actually is. For the past 50 years, we've lived in a world where money is whatever governments say it is. They can print unlimited amounts. They can manipulate interest rates. They can create trillions out of thin air with a keystroke. And for a while, that worked. But it's created the largest debt bubble in human history. Global debt is now over $300 trillion. That's more than 3 times global GDP. It's mathematically impossible to pay back. The only way out is inflation. Devalue the debt by devaluing the currency. Make the numbers work by making the money worth less. And that's exactly what's happening. Real inflation, the kind you experience at the grocery store and gas pump, is far higher than official numbers suggest. Your purchasing power is being systematically destroyed. Your savings are being confiscated through currency debasement. This is why central banks are buying gold. They know what's coming. They're protecting their national wealth from the very system they helped create. Now let me address something important here. If you're sitting on $100,000 or more in retirement accounts, you need to understand how gold IRAs work. I put together a comprehensive guide that covers exactly how to get physical gold into your retirement account without triggering tax penalties. It's in the description below. This isn't about speculation. It's about protecting decades of hard work from currency debasement. Worth checking out if that's relevant to your situation. All right, back to the positioning that's happening right now. The smart money isn't waiting for confirmation. They're not waiting for gold to hit new all-time highs or for silver to break out. They're accumulating now, while prices are still reasonable, while physical metal is still available, while the crowd is still distracted. Let me tell you about the ETF flows, because this tells a fascinating story. Gold ETFs saw massive inflows recently, but here's what's interesting. The inflows are coming from institutional investors, not retail. Retail investors are actually net sellers in many cases. They're chasing tech stocks and crypto. Meanwhile, institutions are quietly building massive positions in physical gold-backed ETFs. This is classic wealth transfer behavior. Retail sells to institutions at low prices. Then, when the trend becomes obvious, retail buys back at much higher prices. It happens in every major market cycle. But this cycle is different because of the physical constraints. In previous cycles, you could always create more paper gold. You could expand the futures market, create more ETF shares, issue more mining stocks. The paper supply was essentially unlimited. Not anymore. The physical market is asserting itself. When central banks buy physical gold, that metal is gone from the market. It's not coming back. When Russia allocates $535 million for physical precious metals, that's real supply being removed permanently. And the available supply is shockingly small. All the gold ever mined in human history would fit in a cube about 70 feet on each side. That's it. That's all the gold that exists above ground. And most of it is already owned and held by central banks, jewelry owners, and long-term investors. The amount of gold available for purchase at current prices is a tiny fraction of global wealth. If even a small percentage of global capital tried to move into physical gold, there simply isn't enough supply. Prices would have to rise dramatically to balance supply and demand. Silver is even more constrained. There's less investment-grade silver available than gold. The silver market is smaller than the gold market in dollar terms. A relatively small amount of capital flowing into silver could move the price dramatically, and that's exactly what's starting to happen. Let me give you a specific example of how this plays out. In 2008, during the financial crisis, there was a brief moment when you couldn't buy physical silver at any price. Dealers were sold out. Premiums over spot price went to 50%, 100%, even higher. The paper price said one thing, but you couldn't actually buy physical metal at that price. That disconnect is starting to happen again. Premiums on physical gold and silver coins are elevated. Delivery times are extending. Dealers are having trouble sourcing supply. These are early warning signs that the physical market is tightening. Now let me connect this to the broader economic picture because this isn't happening in a vacuum. We're in the late stages of a debt supercycle. Interest rates were held artificially low for over a decade. This created massive malinvestment. Zombie companies that should have failed were kept alive by cheap debt. Asset bubbles inflated across stocks, bonds, and real estate. The entire system became dependent on ever-increasing amounts of debt and ever lower interest rates. But inflation forced central banks to raise rates. And now the system is breaking. Banks are failing. Commercial real estate is imploding. Government deficits are exploding. The debt service costs alone are becoming unsustainable. The only way out is to devalue the currency, print more money, inflate away the debt. And that's exactly what's coming. Central banks will pivot back to easing. They'll restart quantitative easing. They'll find new creative ways to inject liquidity into the system. And when they do, gold and silver will explode higher. But here's the key insight. The central banks buying gold now know this is coming. They're positioning before the pivot. They're accumulating before the announcement. They're protecting their reserves before the currency debasement accelerates. This is insider information in plain sight. You just have to pay attention to what they're doing, not what they're saying. Let me tell you about the BRICS nations, because this is a crucial part of the story. Brazil, Russia, India, China, South Africa. These countries represent nearly half of the world's population and a growing share of global GDP. And they're actively working to reduce their dependence on the US dollar. They're settling trade in local currencies. They're building alternative payment systems. They're accumulating gold as a neutral reserve asset. This isn't a conspiracy theory. This is official policy, announced publicly, implemented systematically. The petrodollar system, which has underpinned US dollar dominance for 50 years, is being dismantled. Saudi Arabia is now accepting yuan for oil. Russia is selling energy in rubles. China is settling trade with dozens of countries in yuan. The exclusive use of dollars for international trade is ending. And what's the alternative? What's the neutral reserve asset that no country controls, that can't be printed, that has been money for 5,000 years? Gold. This is why central banks are accumulating. They're preparing for a new monetary system, one where gold plays a much larger role, one where currencies are at least partially backed by physical assets, one where the unlimited money printing of the past 50 years is no longer possible. And if you understand this, if you see what's coming, then you understand why positioning yourself now is so critical. Let me give you another historical parallel. In the 1970s, gold went from $35 to $850. That's a 24 times increase. But it didn't happen overnight. It happened in stages. There were periods of consolidation, periods of explosive moves, periods where everyone thought the bull market was over. But the underlying fundamentals kept driving prices higher. Inflation was out of control. The dollar was losing value. Debt was exploding. And gold was the only asset that protected purchasing power. We're in a similar setup now, but with even more extreme fundamentals. The debt levels are higher. The money printing is more aggressive. The currency debasement is more severe. And the central banks are buying gold at a faster pace than the 1970s. If gold went 24 times in the 1970s, from a much more stable starting point, what could it do in this environment? And silver, which tends to outperform gold in bull markets, could do even better. In the 1970s, silver went from $1.50 to $50. That's a 33x increase. And it happened in a much shorter time frame than gold. The leverage in silver is extraordinary, but it comes with volatility. Silver can drop 30% in a matter of weeks, then double in a matter of months. It's not for the faint of heart. But for those who understand the fundamentals and can handle the volatility, the potential returns are staggering. Now, let me address the skeptics. There are people who will tell you that gold is a barbarous relic, that it doesn't generate cash flow, that it's just a shiny rock with no intrinsic value. These people are missing the point entirely. Gold isn't an investment, it's insurance. It's a store of value. It's a hedge against the debasement of fiat currency. It's a way to preserve purchasing power across generations. And right now, with central banks buying at record pace, with the debt bubble at historic extremes, with inflation eroding purchasing power, with the dollar's reserve status being challenged, right now, that insurance is more valuable than ever. But here's what makes this moment unique. You're not just buying insurance. You're positioning yourself for a massive revaluation. You're getting in before the crowd realizes what's happening. You're accumulating while prices are still reasonable and physical metal is still available. The wealth transfer has begun. The question is, which side of it will you be on? Will you be holding paper promises that lose value as currencies are debased? Or will you be holding physical assets that preserve and grow wealth as the monetary system resets? The central banks have made their choice. They're buying gold and reducing dollars. Russia is allocating hundreds of millions to precious metals. China is accumulating. Poland, Hungary, Singapore, India. The list goes on. These aren't stupid people. They have access to information and analysis that most investors never see. And they're all doing the same thing. They're moving out of paper and into physical. They're reducing dollar exposure and increasing gold holdings. They're preparing for a monetary reset. And you can do the same thing. You can position yourself the same way the central banks are positioning. You can protect your wealth the same way nations are protecting their reserves. But you have to act while physical metal is still available. You have to position before the crowd realizes what's happening. You have to move before the premiums explode and the supply dries up. Let me give you one final thought. In every major wealth transfer throughout history, there's a moment when the trend becomes obvious to everyone. When the crowd finally understands what's happening. And by that point, it's too late to position optimally. You're buying at much higher prices, competing with millions of other people, dealing with supply shortages and extended delivery times. The smart money positions before that moment. They accumulate when prices are reasonable, when supply is available, when the crowd is still skeptical. That moment is right now. The central banks are showing you exactly what to do. They're buying gold at record pace. They're diversifying into silver and other precious metals. They're reducing their dollar exposure. They're preparing for a monetary reset. The wealth transfer has begun. The positioning is happening. The only question is whether you'll participate or watch from the sidelines as the largest revaluation of wealth in modern history unfolds. The evidence is overwhelming. The data is undeniable. The implications are staggering, and the opportunity is right in front of you. What you do with this information is up to you. But understand this. The central banks aren't buying gold because they're confused. They're not accumulating at record pace because they're making a mistake. They're positioning because they know what's coming. And now you know too. The wealth transfer has successfully begun. The question is, are you positioned?